Preparing for a C Financial interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about C Financial? C Financial is a diversified wealth and asset management company with Canadian roots and a significant U.S. presence. I would describe its businesses across asset management, wealth management, and related advisory platforms, then connect them to recurring fee revenue, client assets, and operating leverage. I would also mention its acquisition-led expansion and the importance of integrating firms while protecting client relationships, investment performance, compliance, and culture. That combination makes execution and capital allocation especially relevant. While answering, focus on C Financial's Canadian roots, global wealth and asset management businesses, recurring fee economics, acquisition strategy, client-centric model, and the importance of integrating platforms while preserving performance and service quality. Question 2. How would you describe C Financial's business model? The model is primarily fee-based. C earns revenue from managing investment assets, administering portfolios, and supporting wealth advisory relationships, while expenses include investment personnel, compensation, distribution, technology, regulatory costs, and corporate overhead. Revenue generally grows when client assets rise through market appreciation, positive net flows, or acquisitions. Profitability then depends on fee rates, product mix, advisor productivity, and cost discipline. I would distinguish recurring operating revenue from one-time transaction effects. Make sure to cover asset management fees, wealth management fees, client assets, advisory relationships, distribution channels, operating costs, recurring revenue, and how market performance and net flows influence reported results. Question 3. What are the main drivers of C Financial's revenue? The largest driver is the amount of client capital generating fees. I would break changes into market appreciation, net client flows, acquisitions, foreign exchange movements, and changes in fee rates or product mix. Higher margin advisory or alternative products may affect revenue differently from lower fee passive products. I would also separate recurring management and advisory fees from transaction gains or other unusual items. That bridge helps explain whether growth is durable or merely market-driven. In your answer, talk about assets under management, assets under administration, fee schedules, net sales, market returns, product mix, acquisitions, foreign exchange, and the difference between recurring fees and non-recurring revenue. Question 4. What is the difference between AUM and assets under administration? AUM generally represents assets for which the firm provides investment management and earns a management fee. Assets under administration can be broader, including assets held or serviced on a platform even when another manager makes investment decisions. For C, both measures can demonstrate platform scale, but they have different revenue implications. I would never assume $1 of administered assets produces the same economics as $1 of directly managed assets. Fee rates and services must be examined. Be sure to mention who controls investment decisions, whether assets generate management fees, reporting distinctions, wealth platform economics, and why both measures matter when evaluating C Financial's scale and performance. Question 5. How would market volatility affect C Financial's financial results? Market volatility affects C through both asset values and client behavior. A market decline can reduce AUM and therefore fee revenue, while nervous investors may redeem or shift toward lower fee products. Volatility can also increase foreign exchange effects and create pressure on margins if costs are less flexible. I would analyze the impact by asset class, geography, fee rate, and flow behavior, then consider cost actions, product diversification, and balance sheet capacity. The key is separating temporary markets from structural outflows. Focus on the effect of equity and fixed income markets on client assets, fee revenue, margins, net flows, foreign exchange, investor sentiment, and management actions that can protect profitability during downturns. Question 6. Which financial statements would you analyze first when evaluating C Financial? I would start with the income statement to understand revenue, compensation, operating expenses, margins, and earnings trends. Then I would review the balance sheet for cash, debt, goodwill, intangible assets, and liquidity. The cash flow statement helps distinguish accounting earnings from cash generation and shows acquisition or debt activity. Finally, I would read segment disclosures and client asset metrics, because reported consolidated results can hide differences between asset management, wealth management, and acquired platforms. Make sure to cover the income statement, balance sheet, cash flow statement, client asset disclosures, segment reporting, operating metrics, debt, goodwill, and reconciliation of accounting results to business performance. Question 7. How does C Financial account for an acquisition? I would apply acquisition accounting by measuring the consideration transferred and allocating it to identifiable assets and liabilities at fair value. Client relationships, trade names, technology, and other intangibles may be recognized separately from goodwill. Deferred taxes can arise from fair value adjustments, while transaction costs are generally expensed rather than included in goodwill. After closing, the acquired results are consolidated, and goodwill and indefinite-lived intangibles must be monitored for impairment. I would document assumptions carefully. In your answer, discuss purchase consideration, identifiable intangible assets, fair value adjustments, deferred taxes, goodwill, contingent consideration, transaction costs, consolidation timing, and subsequent impairment testing. Question 8. What factors could lead to goodwill impairment at C Financial? Goodwill impairment becomes more likely when an acquired business produces weaker cash flows than expected. Warning signs include persistent client outflows, lower fee rates, margin compression, failed integration, higher discount rates, or regulatory damage. I would compare the reporting unit's carrying value with its estimated recoverable value using realistic forecasts and market assumptions. An impairment is usually non-cash, but it signals that acquisition economics have deteriorated and may affect leverage metrics, investor confidence, and future strategy. Cover declining share price, reduced cash flow forecasts, client outflows, lower margins, integration problems, higher discount rates, adverse regulatory developments, reporting unit performance, and the distinction between non-cash impairment and cash losses. Question 9. How would you assess whether an acquisition is financially attractive? I would begin with the purchase price relative to recurring revenue, EBITDA, client assets, and expected cash generation. Then I would assess retention, fee levels, organic growth, cost synergies, cross-selling, integration spending, and funding costs. I would model standalone and combined cases, including downside assumptions for market declines and client attrition. Attractive earnings accretion is not enough. I would want the projected return on invested capital to exceed the cost of capital and remain compelling after execution risks. Be sure to mention purchase price, recurring revenue quality, client retention, synergies, integration costs, valuation multiples, accretion, return on invested capital, financing, risks, and sensitivity analysis. Question 10. What is the importance of client retention in C Financial's business? Client retention is central because the business monetizes long-term relationships rather than one-time product sales. Losing clients reduces assets, recurring fees, and the expected value of an acquisition. I would monitor gross outflows, net flows, household retention, advisor turnover, complaints, and service metrics. Strong investment performance helps, but communication, technology, trust, and advisor continuity also matter. In an acquisition, retention is often the difference between achieving the modeled synergies and overpaying for assets that later leave. Focus on recurring fee revenue, lifetime client value, switching costs, advisor relationships, service quality, investment outcomes, acquisition assumptions, net flows, and how retention affects valuation and integration success. Question 11. How would you analyze C Financial's operating margin? I would decompose margin movement into revenue growth, fee rate changes, asset mix, compensation, distribution, technology, regulatory spending, and corporate costs. I would distinguish reported margin from adjusted margin by identifying acquisition costs, restructuring, amortization, and other unusual items. Higher margins may reflect genuine operating leverage, but they could also result from temporary cost reductions or favorable markets. I would compare trends across segments and test whether savings can continue without weakening client service, compliance, or growth investment. In your answer, cover revenue growth, compensation, distribution expenses, technology, regulatory costs, acquisition synergies, fee mix, operating leverage, adjusted versus reported margins, and sustainability of improvements. Question 12. What accounting issues are particularly relevant for an asset and wealth management company? I would pay close attention to management and advisory fee recognition, performance-based fees, valuation of investments, consolidation judgments, acquisition intangibles, goodwill, and deferred taxes. Compensation and incentive accruals also require careful period matching, particularly when awards depend on future performance. Client assets may be disclosed or administered without being recognized as company assets, so presentation matters. I would connect each accounting judgment to controls, estimates, audit evidence, and the risk of misstating recurring earnings. Make sure to discuss fee recognition, performance fees, investment valuation, consolidation, goodwill, intangible amortization, deferred taxes, leases, compensation, regulatory capital, and disclosure of client assets. Question 13. How would you forecast C Financial's revenue? I would build the forecast from client assets rather than applying a simple revenue growth rate. Starting with beginning AUM or advisory assets, I would model market returns, gross sales, redemptions, net flows, acquisitions, foreign exchange, and fee rates by product or segment. Average assets, rather than ending assets, should drive most fee revenue. I would create base, upside, and downside cases, then reconcile the forecast to historical seasonality and management's stated strategic priorities. Discuss beginning assets, market returns, gross sales, redemptions, net flows, acquisitions, fee rates, product mix, foreign exchange, seasonality, and separate base, upside, and downside cases. Question 14. What valuation methods would you use for C Financial? I would use trading multiples such as price to earnings and enterprise value to EBITDA, supported by a discounted cash flow analysis. Revenue or asset-based metrics can provide context, but profitability and cash conversion matter more. I would compare C with asset and wealth managers while adjusting for growth, fee mix, margins, leverage, geography, and acquisition exposure. In the DCF, I would sensitize market returns, net flows, fee rates, margins, terminal growth, and the discount rate because small changes can materially affect value. Be sure to cover price to earnings, EV to EBITDA, discounted cash flow, price to assets or revenue where relevant, comparable companies, precedent transactions, fee economics, leverage, and sensitivity to markets and flows. Question 15. How would rising interest rates affect C Financial? Higher rates can affect C in several directions. They may pressure equity valuations and bond prices, reducing client assets and fee revenue, while encouraging some clients toward cash or fixed income products. At the same time, cash balances may earn more, although company debt and acquisition financing become more expensive. Higher discount rates also reduce valuation multiples and DCF values. I would evaluate duration, asset mix, client flows, debt maturities, and whether product demand or cost actions offset the pressure. Focus on market valuations, fixed income performance, client behavior, cash yields, borrowing costs, discount rates, acquisition financing, product demand, and the offsetting effects on revenue and expenses. Question 16. What controls would you expect in C Financial's finance function? I would expect controls over the monthly close, fee calculations, client asset reconciliations, investment valuations, journal entries, consolidation, and financial reporting. Key principles include segregation of duties, restricted system access, independent review, documented evidence, and timely account reconciliations. Acquisitions require additional controls around opening balances, fair values, purchase accounting, and integration reporting. I would also monitor deficiencies through root cause analysis and remediation tracking, rather than treating control testing as a checklist exercise. In your answer, mention reconciliations, journal entry approvals, fee calculations, valuation controls, segregation of duties, access management, acquisition reporting, close procedures, documentation, and remediation of control deficiencies. Question 17. Describe how you would investigate an unexpected variance in management fee revenue. I would first validate the report and confirm that the period, entities, products, and accounting treatment are consistent. Then I would bridge revenue using average assets, market movement, net flows, fee rates, product mix, acquisitions, and foreign exchange. I would compare actual rates with contracts and prior periods, test system interfaces, and investigate unusual manual entries. If the variance remained unexplained, I would quantify the potential misstatement, document the analysis, and escalate it before closing the books. Make sure to cover data validation, period comparison, AUM changes, fee rates, product mix, flows, market returns, acquisitions, foreign exchange, system interfaces, and escalation of unresolved issues. Question 18. Tell me about a time you improved a financial process. In a prior role, a recurring reporting process depended on manually combining several spreadsheets, which created delays and review errors. I mapped the workflow, identified duplicate inputs, standardized definitions, and built a controlled template with automated checks and clear ownership. I tested the output against prior periods, documented the procedure, and trained users. The process shortened turnaround by roughly 30% and reduced review comments. I learned that sustainable improvement requires both better tools and disciplined governance. Focus on the original problem, your analysis, stakeholders, specific process change, controls, measurable result, communication, and how you ensured the improvement remained sustainable after implementation. Question 19. Why do you want to work at C Financial? I am interested in C Financial because it combines recurring financial services economics with a complex, evolving platform. The mix of asset management, wealth management, acquisitions, and international operations would let me apply accounting and analytical skills to issues that directly influence client outcomes and shareholder value. I also like environments where process improvement matters, because scale creates opportunities to strengthen reporting and controls. This role appeals to me specifically because I can contribute while continuing to develop commercially. Be sure to connect your skills to C Financial's wealth and asset management model, acquisition and integration environment, client impact, Canadian and international footprint, learning opportunities, and the specific roles responsibilities. Question 20. If C Financial acquired a wealth management firm, what would you review during the first 90 days? During the first 90 days, I would establish reliable baseline data for clients, assets, revenue, expenses, and retention. I would verify opening balances, purchase accounting entries, fee calculations, regulatory obligations, and key controls. Operationally, I would assess technology interfaces, advisor and employee retention, service continuity, and data quality. I would create a synergy tracker with owners, timing, costs, and risks, while preserving client communication. Early success means accurate reporting, stable relationships, and measurable integration milestones. Discuss client and advisor retention, revenue quality, data integrity, opening balances, controls, technology integration, regulatory obligations, synergy tracking, employee culture, risks, and clear milestones for post-close execution. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.